Welcome to The Explainer. Today, we're going to tackle a question that honestly trips up a lot of businesses when they're calculating their taxable income. We're talking about the pay-to-claim rule, which is now under Section 37 of the new Income Tax Act 2025. So let's start with a scenario that probably sounds pretty familiar. A real year-end headache. You've booked a valid business expense in March, right? But the actual cash doesn't leave your bank account until July. So the question is, can you still claim the deduction for that financial year? It seems like a simple question, but the answer, well, it can make a huge difference to your tax bill. And the answer lies in this really powerful rule called the pay-to-claim rule. It's now officially part of Section 37 of the Income Tax Act 2025. Now, for those of you who've been around the block, you'll recognize this. It carries forward the same core ideas from the old Section 43B of the 1961 Act. So why does the tax law even have this rule? I mean, why insist on it? It's actually a very deliberate move away from the standard accounting practices that most businesses use every day. Understanding the why behind it is really key. You see, most businesses run on what's called the accrual or mercantile basis. Basically, the moment you have an obligation to pay something, you record it as an expense. That's standard accounting. But Section 37 comes along and says, not so fast. For a specific list of payments, it completely overrides this method. The logic is really simple and absolute. The government wants to be sure that certain critical payments are actually made, not just sitting on your books as a liability. So the rule is, if you haven't paid it, you can't claim it for tax purposes that year. It's that black and white. Okay, so that's the rule. But which expenses actually fall under this? The list is very specific, and it targets those key statutory and business obligations that the government really wants to see paid on time. First up, we've got all the dues to the government and to your employees. This covers any kind of tax, duty, cess, or fee. It also includes those super important employee welfare contributions, like Provident Fund and gratuity. And yes, it even covers leave encashment, all to make sure employee benefits are funded when they should be. Then you have the second category, which covers key financial obligations like interest on loans. But this is the one that has a massive impact on almost every single business. Payments to your suppliers who are registered as micro or small enterprises, or MSMEs. This particular rule is a really powerful tool designed to enforce prompt payment and protect the cash flow of these smaller businesses. So here's the burning question. If you miss paying one of these expenses by March 31st, is that deduction just gone for that tax year? Well, not always. The law actually builds in a vital lifeline for taxpayers. And this is that lifeline. Section 37, subsection 3, gives you a grace period. What it says is, if you make the payment after the tax year ends, but on or before the due date for filing your income tax return, you can still claim that deduction back in the year the expense originally happened. Now, this flexibility is a huge relief, especially when you're managing cash flow at the end of the year. But, and this is a big but, it's absolutely essential to know that this grace period does not apply to every single item on that Section 37 list. Okay, let's be crystal clear on this one because this is the big exception. That grace period we just talked about, it absolutely does not apply to payments you owe to micro and small enterprises. For your MSME suppliers, you have to pay them within the timeline that's specified in the MSME Act of 2006, which is typically 15 or 45 days. If you pay late, that deduction is disallowed for that tax year, and that tax return deadline is not going to save you. The best way to understand this is to see it in action. So let's walk through a quick practical case study to see the real-world impact of this difference. So check this out. We've got two expenses, both booked in February 2027. The Provident Fund contribution gets paid in August. Now, since that's before the ITR filing due date, you're good. The deduction is allowed for the 2026-27 tax year. But look at the MSME supplier bill. It was also paid in August, but that's way beyond its statutory limit. The ITR grace period doesn't apply here, so that deduction is disallowed for that year. You can only claim it in the next tax year, which is when it was actually paid. So with all these complexities, especially that MSME rule, how do you make sure you're staying compliant? And more importantly, how do you avoid these really common and often pretty costly mistakes? Really, it comes down to a simple, disciplined three-step approach. First, you have to systematically identify all your vendors and liabilities that fall under Section 37. Second, you need a rock-solid tracking system for the actual dates of payment. And third, before you even think about filing your return, you have to do a thorough reconciliation. Make sure every single deduction you're claiming has proof of payment within those strict timelines. And these are the traps that businesses just keep falling into. The number one mistake by far is assuming the grace period applies to MSME payments. Other common ones are just not having proper proof of payment or getting different due dates mixed up. Oh, and here's a classic error: forgetting to claim the deduction in the following year when you finally made the late payment. Remember, a disallowed expense is usually just deferred, it's not lost forever, but you have to actually remember to claim it later.
All right, we've gone through a lot of detail on Section 37, so let's just step back and summarize the absolute most important points that you need to take away from this.
So let's boil it right down. First, always remember the core principle. For these specific expenses, it's pay to claim. Second, you do have that grace period lifeline right up until your tax return is due. But, and this is the big one, the critical point, that lifeline does not apply to your payments to micro and small enterprises. And finally, none of this matters if you can't prove it. Documentation of when you paid is absolutely everything.
And that leaves us with a final thought to chew on. This strict rule for MSME payments isn't just about tax compliance. It's actually a policy tool, and it's designed to enforce financial discipline and really support that small business ecosystem. So the big question is, could this fundamentally rewire how larger companies manage their cash flow and their entire procurement process?
We really hope this breakdown of Section 37 was clear and helpful for you. If you found it valuable, please do us a favor and share it with other business owners and tax pros in your network. Thanks so much for joining us. Please just take a quick moment to read our standard disclaimer.